The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box. These are your headlines. Technology stocks leading quite a meaty sell-off on Wall Street, actually, with the S&P 500 and the Nasdaq posting their worst session since 2022. This also triggering a downturn in Asian stocks. The French luxury group Kering sees quarterly sales sink due to weakness, yes, you guessed it, China, and first half profit plunging, expected to fall by a further 30% in the second half.
Renault reports a record profit margin in the first half. That's amid strong EV sales and as cost cuts pay off, while the French automaker backs its full-year outlook. And Ford slams its extended trade, or rather slams the slumps in extended trade, should I say, after posting its biggest earnings miss in more than 2 years and disappointing investors who wanted to see improved guidance from the auto giant.
Right, we've got a bit of everything for you. We've got the politics going into the mix. We've got the earnings going into the mix. We've got the economics as well. There is a lot in there as well. Let's start off with one of the biggest companies in Europe, Roche Pharmaceutical Group. Outlook 2024 expects an increase in groups. By the way, very rude of me. Good morning, Arabile.
Yeah, good morning.
Let me get my manners sorted out first of all. Right, okay, here we go. Outlook, Roche 2024. Roche expects an increase in group sales in mid-single digit range. That's on a CER basis. Pharmaceutical division sales rose by 5% in the first half. Earnings raised in terms of the outlook for 2024. That's a great message to give at the moment, especially when we're seeing everybody having a think about where they want to place themselves sectorally as well. And do pharmaceuticals now fulfill one of their more traditional roles of being a bit of a port in the storm as we see this sell-off globally on technology stocks? Group sales accelerated growth to 9%. That's 7% in Swiss francs in the second quarter. This looks broadly reassuring across the board. What else am I going to give you here? I'll give you one or two more. Core operating profit in the first half grew by 11%. And Roche expects to further increase its dividend in Swiss francs. Right, we move to the shares, and you can see there the shares have pretty much had a solid run so far this year, up 12%. I can tell you they trade on around about mid-teens digits, around about 14, 15 times forward, which is actually one of the few examples where you'll find a premium to some of the biggest players in the United States, including the likes of Pfizer. We will break down these numbers further with the CEO of Roche, that is Thomas Schinecker. First on interview coming up in just under 1 hour's time. Right, let us move down the lane in Switzerland to Nestle's.
Indeed, Nestle.
Macintosh.
Yes. So this is going to be another one where you wonder about just the pricing pressure, consumers, and whether their strength has actually been maintained somewhat. Well, just on the top line itself, not a beat. It's actually drawn off from where the market had anticipated. 45.3 billion was what the market had anticipated. Swiss francs, that is. Indeed, it's a flat 45 billion for the sales number. So the top line figure then for Nestle. Organic revenue estimated to be 2.5%. Only coming out at 2.1%. So still another one there not beating the estimate in the market. Organic growth is also an interesting one. And organic sales growth there, 2.1% is the figure to have come out. The market was looking for 2.5% on that one. Just looking at the 2024 outlook, then the company saying that it expects pricing to actually come down faster than expected, although underlying trading operating profit is unchanged. Reporting that sales figure, 45 billion Swiss francs. Their trading operating profit margin, 17.4%. Real internal growth, that was seen falling 0.5%, but they managed to see internal growth actually of 0.1% amidst that organic growth figure of 2.1%. So just taking a look at the shares year to date, Nestle has gone down 4%. As you can tell there, that a drawdown for this year, just under 100, as you can tell, on that figure overall. So we will continue to unpack this one just a little bit more for you across the day's trading, just giving you a little bit more, just trying to look for that forward PE, around 18 for Nestle currently compared to some of its industry players.
1987, by the way, is the answer.
When I was born, no, that's 88.
1987 is when Roundtree's Macintosh was taken over by Nestle. And the terrible thing is this correspondent remembers that. Moving on.
There for that.
Well, it wasn't working just yet. I was nearly working. And we're going to have another check on the consumer space when Unilever reports at 8 a.m. Central European time. Our very own Sylvia will be sitting down with the CEO, Heinz Schumacher, later today. Don't miss that interview at 9:15 Central European time.
Well, here's something we were all for. Yesterday's downturn in this market picture, right? That sell-off is really what we saw in play. They say be careful what you wish for. The market, perhaps a lot of people speaking about you could get some sort of a return to some of the other unloved stocks, perhaps a sell-off then in this market, somewhat of a correction. Is that what you're seeing right now then? It was an intense drawdown, that's certainly for sure then, with a significant drop of more than 2% then for the S&P 500. But the tech-heavy Nasdaq then seeing a big decline, 3.6%. Is this just on the back of the numbers out of Tesla as well as Alphabet, which were, I guess, middle of the road in some instances and really not looking too good when it comes to the likes of Tesla as well, some negativity as well on that stock. Did that lead a lot of this decline? Well, certainly you see the likes then of Tesla dropping off around 12% in the day's trading. The Dow shed roughly 500 points. It was also its fourth negative session out of the last 5. Could this be that overdue correction, as I've been noting then as well? Investors have fled a lot of those tech stocks, though. Utilities, however, were the ones who actually managed to move higher, jumping 1.6%. As 7 sectors did indeed dip. And here are your big tech players then as well. This is what we're looking at. It is a drawdown across the board here. The Mag 7 plus the others as well, just adding Netflix as well to this. You're seeing a 1% decline as well there. Meta 5.6%. 5% down for Alphabet on the back of all of that. But as I've been noting, Tesla, 12% drawdown. Worry then as to whether that AI play continues. The robo-taxi being delayed then until October. 10th of October is when we're now anticipating to see more of that come forward. But is there still something to say with regards to the earnings picture? Of course, then more than 25% of companies in the S&P 500 have reported their second quarter earnings. There's still more at play. Could the tech counters still see a little bit more of an uptick? Let's move on to the Treasuries picture here. Then in the US yield curve actually steepened sharply amid growing calls for Fed rate cuts to begin even as early as next week. According to some analysts, yields on 2-year yields sliding by 3 basis points then yesterday. The 10-year, however, managed to move up by the same margin. So that went up 3 basis points instead in yesterday's trading. The differential between those was now 14 basis points, the smallest margin since October 2023. So 4.26 now for that 10-year note, the more rate-sensitive 2-year at 4.39. Now, the Japanese yen, well, that's strengthening against the dollar, with the Bank of Japan reportedly said to consider hiking rates when it meets next week. That's according to a report from Reuters, which describes the central bank's decision as a close call. That's amid uncertainty around the consumer outlook. Overall, though, the Asian trade is downbeat then. The Nikkei, following that report, down nearly 3% then in this early morning trade, extending what is a 6-day losing streak then, plunging as well, and leading the losses across the Asian market picture. The Hang Seng also 1.4% weaker so far this morning. Likes of SoftBank Group nosediving 7%, while Renault Electronics also led losses there, down 14% as well across the Asian picture. Scaling multi-month highs as well was the yen. It's a very interesting picture to look forward to, the currencies as well.
Right, Arabina, let's just get our job right here. We are not apologists for the bull market. We are not cheerleaders for the market. I see too many financial commentators globally, and dare I say it, I see some on this channel and I see some on other channels as well, who are like only happy when the market's going up and are dismal and like apocalyptic when the market goes down. Quite frankly, I care more about our viewers than telling them just to keep buying on the upside, because I've seen it in 1987, 1986, I've seen it in 1997, 1998, I saw it in the dot-com bubble burst, I saw it in the GFC, I've seen it various times. If you only want the market to go one way all the time, then you are just going to look a bit stupid when the market has these retrenchments. The fact of the matter is the market is at the moment in a very solid place as well. The earnings figures are coming in pretty good, although there are concerns. And actually, I'm more interested in what Whirlpool had to say and what Ford had to say yesterday than this decline in the markets. But everyone else wants to talk about decline in the markets, so I'll go with it as well. Look, by and large, the stocks that fell off aggressively yesterday have had a fantastic run this year. They have had a fantastic rally over the last 2 years as well, which is the kind of time frame we're talking about, the biggest decline since 2022. Let me just go through these big stocks, and then, of course, the notable exception being Tesla. Year to date, Amazon is up 19.1% after yesterday's move. Meta, Facebook, up 30% after yesterday's move. Microsoft, more modest, up 14%. Nvidia, wait for it, up 130%. And Google, Alphabet, is up 23%. These are solid companies throwing off large amounts of cash with pretty solid growth potential going forward. If there is a bit of froth being taken out of these stocks, is it good for traders or investors? And the answer is, could be for both, because if you're an investor, you don't care about one day's move. You are looking at dollar cost averaging your position over a longer term period of time. How many times have we seen some of the best investors coming through this channel going, actually, we don't care about one day's move. We'll just dollar cost average. We'll keep moving into the stock because we like it, whatever the stock is as well. The notable exception yesterday was Tesla as well. And I think Tesla is a great example of the other phenomenon that's going on. One of the other phenomenons that's been going on all year, where people are beginning to say, hang on a second, it's not just about the promise of jam tomorrow. To show us your results today. Now, and I've read a large amount of copy on Tesla, just to confirm my views or distract from my views. I like to see what people who disagree with me are saying out there. I think it's very important for us all to do that. And the fact of the matter is, Tesla is a company that at the moment is stunningly underwhelming on today's numbers, on the projections for their core automobile business. But they have some really exciting stuff going on. They have amazing energy storage operations. They have amazing hope on robo-taxis, which we talked about at length yesterday. But that is a story about jam tomorrow. That is a potential growth story.
AI play might be somewhere else.
So I know I've gone on in my monologue, but I'll finish off in a second. But the fact of the matter is, people are now looking at today's numbers. They're looking at what are you actually delivering rather than what you're promising. And there's always a mix. You always have to think about the growth potential when you're buying these companies. You always have to hold your nose and jump in a little bit as well. But people are more demanding on actual realization of profits. And the problem is, it has gone X growth, as Webb Bush, or no, Jeffries, I think it was a couple of quarters ago. They've gone X growth on their core business. They may have some brilliant stuff down the line, but at the moment that's not turning in the profits.
And then you have the sentiment yesterday where Elon Musk puts out a tweet saying, well, should I actually take money from Tesla on this AI play and actually put it into XAI? Then you ask yourself, well, what is the hope that you are actually then laying onto to Tesla then? Because that's what you've been holding out for, to say, okay, there's this technological play that we wanted to see out of Tesla. If you're not actually going to be putting that forward, then what are we actually doing here?
Hang on a second. Am I missing my timeline here? Because didn't Elon Musk, wasn't his great pitch for his $56 billion? Wasn't his great pitch that I will keep my AI R&D, my AI growth strategy within Tesla if you give me this $56 billion. And now he's still raising that other question? I don't know. My other point is, again, most of the great CEOs at Amazon, Meta, Microsoft, Alphabet, I only see them with one proper job. Whereas, dare I say it, Elon Musk is the only one who seems to have about 5 proper jobs. I'm just saying it seems true. The other thing to say is this great stat. Did you do it at the wall? I don't know if you did. The Russell 2K.
No, I didn't do that one.
Right, this is a stat. We both saw it. It's not ours. It's in the Wall Street Journal. We saw it. This is very interesting. The Russell 2K, okay, it fell yesterday. What did it fall yesterday? 2.1%.
Yeah.
It is up 10.9%. Was it versus the S&P?
Yes, over the last 10.
Over the last 11 sessions.
Days, yeah.
That is the largest margin of outperformance in 24 years. So which shows, despite the 2% decline yesterday, the rotation is still very much alive and well. And actually, I just want to talk about this sell-off just one more time. Before we get too exacerbated about the downside or the upside, shall I tell you what the week-to-date moves are on some of these major assets? The Dow is down a mighty 1.1% week to date. The S&P is down 1.4% week to date. FTSE's unchanged, DAX is up 1.2%, and the CAC is down 0.28%. This is not something to get overly worried about just yet.
Yes, there was a day sell-off, but it doesn't mean that the long play for the week even has been anything to really be too worried about, as you make note of there, Steve. Coming up on the show, though, it's another packed earnings day across Europe. We'll be speaking to the CFO of Michelin, as well as the CEOs of Dassault Systems, Roche, and Unilever. All of that coming up on the show.
Listen to CNBC's Beyond the Valley, the podcast that explores the biggest tech news from across the globe. Join me, Arjun Karpal.
And me, Tom Chitty, every week as we bring you insights into the top stories, unpack the latest trends, and find out where the industry is headed.
Now available on Spotify, Apple Music, and Google Podcasts.
US President Joe Biden addressed the nation for the first time since dropping his bid for re-election on Sunday. In a rare speech from the Oval Office, Biden said the time had come to pass the torch to a new generation of leaders, saying it was the best way to unite the nation. Now, NBC's Alice Barr filed this report.
My fellow Americans.
President Biden sitting in the Oval Office he sought to occupy for years, telling the nation why he's walking away.
So I've decided the best way forward is to pass the torch to a new generation. That's the best way to unite our nation.
The president acknowledging his personal struggle as pressure to drop out mounted from fellow Democrats, worried that questions over his age and mental sharpness meant he couldn't beat former President Trump.
I believe my record as president, my leadership in the world, my vision for America's future, all merited a second term. But nothing can come in the way of saving our democracy.
President Biden beginning to outline his legacy, promising to work hard through his final 6 months in office and praising his new choice for nominee, Vice President Kamala Harris.
She's experienced, she's tough, she's capable.
She has quickly consolidated support campaigning today in Indiana.
I am fighting for our nation's future.
As former President Trump shifts gears and sharpens his attacks against a new opponent.
Kamala, you're fired.
President Biden thanking voters for helping him rise from a kid with a stutter to the White House, while arguing the soul of the nation is still at stake.
The great thing about America is here, kings and dictators do not rule, the people do. History is in your hands. The power is in your hands.
Casting it as a choice to move forward or backward as he prepares to move aside. President Biden followed his address with a private moment with his family, then gathered in the Rose Garden with hundreds of White House staffers. Sounds like the description of a farewell party, but he's promising to be very present, both in the job and on the campaign trail for Vice President Harris throughout the rest of his term. In Washington, Alice Barr, NBC News.
Now, the Democratic National Committee approved new rules, meaning the party will legally nominate a presidential candidate via a virtual roll call vote ahead of the party's convention. The new rules also established a window for the Harris campaign and anyone looking to challenge her for the nomination to file the necessary paperwork and obtain signatures before 6 p.m. Eastern Time on Tuesday. Former U.S. President Barack Obama is reportedly planning to endorse Vice President Kamala Harris in her presidential campaign, having privately given his full support for her candidacy. That's according to NBC News. Obama is one of the highest profile Democrats yet to publicly endorse Harris, with sources telling NBC the pair have been in close touch since the beginning of her presidential bid.
There's a lot of speculation about that. I'm just reading one piece that says what Barack Obama really thinks of Kamala Harris. But anyway, let us move on. Moncler posted a first half profit beat as revenues rose 11% to 1.23 billion euros. The Italian luxury group, best known for its puffer jackets, says it saw strong growth in Japan, largely underpinned by tourism and a weak yen. I think Charlotte covered that on a different stock yesterday. That was LVMH, yes. Mainland China also held up. That's interesting. Even as other European luxury houses have been reckoning with a sharp pullback in consumer spending in the country. Kering posted a 42% drop in first half operating profit to 1.6 billion euros and says it expects a further 30% decline in the second half of the year. That's the Gucci owner, by the way. Charlotte, here's my question for you. It's the same story through most of the luxury players. I think Moncler might be a notable exception. It's the same story from LVMH to Kering to the whole lot of them. How many times can these stocks sell off on the same story?
Well, look, the interesting thing with Kering is a bit more similar to Burberry, is that it's a turnaround story within a slowdown of the overall luxury demand. And that's this double challenge that they are suffering from there, because it's a difficult time to operate that turnaround. And we know that when you talk about Kering, you talk about Gucci, how it kind of came out of fashion, and now they brought in a new creative director, but they are in this turnaround moment, change of strategy. They talk about the elevation strategy of Gucci, the CEO saying back in February that it was a pivotal moment in their journey, and that they needed some short-term pain for long-term gain in the transformation of the brand there. But at the moment, it looks like the turnaround is just not happening, well, it's not just yet, and you wonder, will investors lose patience or not? So that really is the key there, because it looks like there is absolutely no improvement at all. Looking at the Gucci sales, they were down 19% in the second quarter after being down 18% in the first quarter. The other houses are down as well. They have other brands like Balenciaga, and it's also down 5% in the second quarter. So overall sales down 11%. The only one that's doing a little bit better is Bottega Veneta, for them up 4%, but it's a very, very small brand compared to all the other ones that they work with. The second largest one, Yves Saint Laurent, is down 9% as well. So some people are wondering now, is it just a Gucci problem or are there deeper problems? Because the other brands are also faring badly. Because if you compare to LVMH, that was out just yesterday, very slow growth, just up 1% on organic sale. But it's still growth compared to what we see at Kering, where it's across the board where we see some weakness. So again, Asia sales, we know the exposure to Asia for Gucci in particular was particularly important. Asia sales down 25%, Gucci itself down 33%. So while we wait, Sabato De Sarno, the new creative director at Gucci that came on board recently, the products are just starting to hit the store. They're just starting to roll out these products. So here again, we don't see the full effect of the transformation at Gucci and how it goes forward. But certainly the fact that the overall demand is having a slowdown, customers picking the brand that they want to go to, and Gucci is still not one of the brands that they go to when they have to buy one luxury item. And that is what they're working on at the moment. The question is, will market have the patience, analysts have the patience on give them the benefit of the doubt and give them the time for that transformation or not?
At the height of COVID, this was a 788.9 euro stock. It is now a 300 euro stock. So I go back to my original question. I'm fascinated to see what the analysts are saying to you on the reports you're reading as well. Every time one of them sells off, they all sell off. When an LVMH has a bad day, Gucci has a bad day, or Kering has a bad day.
To a different extent, though.
Yeah.
Sometimes the reaction goes.
But I mean, when I look at a share price that has fallen 43% over the last 5 years, I say to myself, it's sold off not only on its own stories, but on everyone else's story as well. It trades at 16 times forward now, which you could argue is expensive for a retail stock, but is cheap for a luxury stock as well. So again, one thing I love about this sector, and I think it is not a sector where there is a uniform valuation. Like the other sector we were just talking about, Nestle and Unilever, they all pretty much trade the same kind of levels, between 19 and 21 times forward, or very similar. This sector, you get a massive range.
And you have different kind of players. We were just talking about Moncler. Hermès is reporting tomorrow. We have to wait and see. But certainly it looks like the brands that cater to the wealthier customers are a bit more protected from the squeeze from the aspirational buyer, for example. And when you have brands that rely more on one brand, whether it's Kering or Burberry, they suffer more. The LVMH is always seen as slightly different because of the spread geographically and of all the brands they have.
But there is a commonality between Hermès and Kering, and that is you've got one family that dominates, and in this case, the Pinault family as well.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.